If you're in student loan default and you're counting on your tax refund, there's one uncomfortable truth to know. A collections pause can stop one kind of pain, like wage garnishment, while another kind of collection is still sitting in the background, waiting to hit a federal payment like your refund. By the end of this video, you'll be able to tell whether your refund is actually at risk, what clock you might be on, and the two screens that answer the question in minutes. Here's the real-world version. Let's say Jamie is expecting a $1,800 federal refund. Jamie's loan has been in default for a while, and they heard something like, collections are delayed, so they assume they're safe. They file early, planning to use the refund to catch up on rent and car insurance, and then the refund doesn't land, or it lands smaller than expected, or it disappears into a black hole for a few weeks, and every bill is suddenly late. That's the situation we're trying to prevent, because it's not just a paperwork problem, it's a cash flow shock. Now, what changed? In mid-January, the U.S. Department of Education said it would delay involuntary collections while it works through repayment system changes and new plan rollouts. That's the headline most people heard. But here's the part people miss. Involuntary collections is not one single switch. It's a set of tools. And different tools run on different timelines, with different notices and different lag. So, the safest way to think about this is not, are collections on or off? It's, which tool could hit me, and what proof do I have that I'm clear? There are three big collection pathways to understand in default. One is wage garnishment. Money gets pulled from your paycheck before it even hits your bank. Two is the Treasury Offset Program. That's when the government matches your name against certain federal payments, like a tax refund, and withholds some or all of it to pay a delinquent debt. Three is what I'll call the credit and fees pathway. Negative reporting and collection costs that don't feel like a seizure, but still make borrowing and budgeting harder. Today we're focused on the refund pathway because it hits fast, it's seasonal, and it's the one that creates the biggest "I didn't see that coming" moment. So how does the refund offset actually work? At a high level, a federal agency with a delinquent debt, like a defaulted student loan, can refer that debt for offset. Treasury runs the matching. And when your tax refund is processed, it can be intercepted and applied to the debt. The key detail is that there is usually a notice pipeline. In plain English, you don't just wake up and lose a refund with no warning. A lot of borrowers get a notice of intent to offset, and the notice starts a clock. Studentaid.gov describes it as a 65-day window. If you're trying to stop an offset, what matters is what happens inside that window, not what you plan to do later. This is where Jamie's example gets real. If Jamie gets that notice in January and they file taxes in February without doing anything else, the offset can hit right when the refund would have been the buffer for the month. Now, let's translate that into the two most common misunderstandings. Misunderstanding number one is thinking a pause means your account is clean. A pause can mean the government is not actively starting a specific tool right now, like new wage garnishments. But your loan can still be in default, and the offset pipeline can still exist depending on timing and referrals. The only way to know is to check your status, and check whether an offset is pending. Misunderstanding number two is thinking that getting out of default is instant. Even if you take a step that eventually fixes it, like starting rehabilitation or consolidating, there can be processing time. And the offset list isn't always updated the same day your dashboard changes. So, the practical goal is not perfection. It's to avoid filing taxes while you're sitting in a danger window you didn't know you were in. Let's make the mechanics concrete with a simple timeline. Day 0, you're in default. Then you get a notice that says, an offset is scheduled to begin in 65 days. If you do nothing and you file taxes, your refund is exposed. If you take an action that resolves the default or stops the offset inside that window, you have a chance to protect the refund. But the action has to be real, documented, and processed, not, I tried to call once. That brings us to the three ways people commonly get out of default, and how each one interacts with refund risk. Option 1 is loan rehabilitation. Rehabilitation is basically a structured way to make a series of agreed payments so the default status is removed and collections stop. The detail that matters is the timing. Studentaid.gov notes that to avoid an offset, you generally need to make your first rehabilitation payment within that 65-day window. In Jamie's case, that means if the notice arrives in January, Waiting until March to start is too late for the refund. Option 2 is consolidation. Consolidation rolls eligible loans into a new loan. For some borrowers, it can be a faster way out of default than waiting through months of rehab payments. But it still depends on eligibility, and it still has processing time. Option 3 is paying in full or settling the defaulted balance. That's the cleanest in theory and unrealistic for many people. I'm listing it because it's part of the menu, not because it's the expected path. And this is where the educational framing matters. Different options have different trade-offs. Rehabilitation can restore benefits and remove the default after completing required payments, but it takes time. Consolidation can be faster, but has its own rules. Paying or settling can stop the issue, but demands cash. The right choice depends on timeline, income stability, and what your loan holder will actually accept. So, let's go back to Jamie. Jamie's goal is not to win an argument about policy. Jamie's goal is to keep that $1,800 refund from vanishing while they're trying to stabilize rent, insurance, and groceries, which means the first move is not choosing rehab versus consolidation. The first move is confirming whether the refund is already in the offset pipeline. And that's where the one-screen concept matters. Because you can talk about this for hours, but 2 screens answer 80% of the question. Screen 1 is studentaid.gov. You're looking for your loan status and whether you're in default, delinquent, or in a repayment plan. If it says default, treat that as refund risk is possible, not guaranteed, but possible. Screen 2 is the Treasury Offset Program status check. Offsets run through Treasury's matching. If you're on the offset list, your refund is exposed. If you're not on the list, the immediate risk is lower. Now, do the Jamie walkthrough. Jamie expects a $1,800 refund. Jamie checks studentaid.gov and sees default status. That doesn't automatically mean the refund is gone, but it means Jamie should not file on autopilot. Jamie checks the offset status. If it shows an offset is pending, this becomes a clock problem. If it does not, the goal is to keep it that way. Here's the money math that makes this feel real. If Jamie's refund is $1,800 and the offset takes the full $1,800, that's not a bad week. That's rent, insurance, and groceries for a month. Even a partial offset matters. If $900 gets intercepted, Jamie still has to cover the same bills, just with half the buffer. So the decision variable is timeline. If Jamie needs that refund for essentials in the next 30 days, they want certainty before filing. If Jamie can survive without it, the pressure is lower, and they can focus on fixing default status without a deadline panic. If Jamie has a notice with a 65-day window, timing is the whole game. Studentaid.gov explains that avoiding an offset often depends on what happens inside that window, not after. Now, education-only options because people are in different situations. One option some borrowers consider is rehabilitation. It's a path where you agree to a monthly payment and make a required series of on-time payments. Once completed, the default status can be removed and collections stop. The trade-off is speed. It takes months, so it's not a same-week fix. And studentaid.gov notes that stopping an offset can hinge on getting the first rehab payment in within the notice window. Another option some borrowers consider is consolidation. Consolidation can move you out of default faster in some cases because you create a new loan and roll eligible loans into it. The trade-off is that not everyone qualifies the same way, and processing still takes time, so you want proof of completion, not just an application. Now, here are exactly 3 signals to watch with what they mean. Signal 1, a notice of intent to offset. Where to look? Your mail and your studentaid.gov messages. What it means? You're on a countdown. Typical timing. The notice often references about 65 days before offset is scheduled to start. Signal 2, your studentaid.gov loan status. Where to look, dashboard, loan details, and status. What it means? Default status keeps offset risk on the table. Typical timing. Status can lag the action you take, so keep proof of enrollment and dates. Signal 3, Treasury Offset Program status. Where to look? Treasury's offset status checkline. What it means? Listed equals interception risk until removed. Typical timing, removal can take processing time, so recheck before filing, not just after you start a process. Back to Jamie. If Jamie is listed, they build a backup plan for February bills because the refund timing may not cooperate. If Jamie is not listed, they still watch for notices and keep status from sliding. The mistake that creates the surprise is focusing on the balance and ignoring the pipeline. Offset is not, you owe a lot. Offset is, your refund is a payment stream and your account is flagged. Here's your 2-minute checklist. Log into studentaid.gov and screenshot your current loan status and loan holder. Search for any notice that mentions intent to offset and write down the deadline date. Check Treasury Offset status. If it's pending, do not budget like the refund is guaranteed. If you pursue rehabilitation or consolidation, save written confirmation and the date you started or completed it. Recheck offset status right before you file. The takeaway is simple. A collections delay can be real, and your refund can still be at risk if you're already in the offset pipeline or you miss the notice window. If this helped, subscribe to the Wealth Blueprint for more clear money breakdowns. And leave a comment with the next topic you want covered, or the one part of today's video you want explained even simpler.